All right, so we said we were going to delve a little deeper. What is a temporary account? So let's take the company's accounts, all of them, all the accounts that you've learned so far, all your asset accounts, your liabilities, your equity. So we take the company's accounts and we classify them into two categories: temporary accounts and permanent accounts. Okay, temporary accounts are also sometimes called nominal accounts. And permanent accounts are also sometimes called real accounts. Okay. So the temporary accounts include revenue, expenses, dividends, and income summary. Income summary, that is a new account. Don't worry if it sounds unfamiliar. You have not seen that account. Why? Because it only exists during the closing process. So it's an account that we open up just for a minute while we're doing the closing entries, and then it goes away. All right, so I tell students how to remember this. I say, are you ready to close? REDI. Are you ready to close your temporary accounts? Your temporary accounts are revenue, expenses, dividends, and income summary. So those accounts, so all temporary accounts, we need to bring it to zero. Bring to zero balance. Balance at year end. Whereas permanent accounts will remain open. Remain open at year end. So your permanent accounts is basically everything else. It's your assets. It's your liabilities. And it's your owner's equity. Now, if you think of owner's equity on the balance sheet, there's two line items that make up owner's equity: common stock and retained earnings. So basically, it's your balance sheet that is permanent and it's going to carry forward period to period, which should make sense, right? You're not going to say, oh, I have a cash balance of $60,000, but at year end, I'm going to zero it out and start the new year with no cash. Give it all away. No, of course not, right? So asset balances will remain, liability balances will remain, and equity balances will remain. So let's map through this closing process now. This is so helpful, this overview before we get into the weeds. Okay, so your revenue and your expense account, we will close. That gets closed to your income summary account, that new account. Income summary. So the income summary account only exists to close the items that determine net income, which is revenue and expenses. And if anything, it's because accountants are anal and we like to have one more chance to check, because our income summary account should be equal to our net income for the period. So it's just one more chance for us to check and make sure that we didn't forget to close the account. So we'll match what our balance is in income summary to net income and make sure it's the same. All right. And then after we've closed revenue and expenses to income summary, we will close dividends and income summary. That will get closed to retained earnings. Retained earnings. Okay, which should make sense because retained earnings, as the name suggests, are the earnings the company has been able to hang on to from past time periods. So you're taking all the financial, transactions from prior years and you're bringing it forward to the retained earnings, bringing it forward. Okay, we're not just losing all that activity. It's going to be reflected in the retained earnings account, which will stay open. Okay, so let me go back a slide and we can kind of add to our notes there. So how do we do it? And we also transfer the periods net income, and dividend activity to retained earnings. That's what else closing entries do. Yes, we bring all temporary accounts to a zero balance, but where does that money go? Where does the balance in revenue go? We can't just make it disappear. We have to take it somewhere. It's going to transfer to retained earnings. Okay, and that is a beautiful overview right there of what we're about to get into with our journal entries. So I think this note, this page right here will really help you. All right, so print it out, keep it in your notebook. I think it'll help you as we work along.